How much retirement investment risk is right for me? Imagine standing at a crossroads, unsure which path leads to a secure and comfortable retirement. Deciding how much risk to take with your investments can feel just like that. It's a personal choice that depends on several important factors. First, think about your age and how many years you have before you plan to retire. If you are in your 30s or 40s, you have plenty of time to recover from market downturns, so you can usually accept more risk. For example, someone in their 30s investing for retirement 30 years away might put more into stocks, which can grow faster but also fluctuate more. On the other hand, if you are nearing retirement in 5 or 10 years, it's smarter to shift toward safer investments like bonds or cash. Your current financial situation also matters. If you have a steady income, emergency savings, and no urgent need to access your investments, you can handle more risk. But if your income is uncertain or you depend heavily on your investments for income soon, lower risk options are safer. Next, clarify your goals. Do you want your savings to grow aggressively, or do you need steady income and capital preservation? If your goal is to grow your money fast, you might accept higher risk. If you want stability, lower risk investments make more sense. Risk tolerance is about how comfortable you are with market ups and downs. Some people can handle big swings without stress, while others get anxious when their investments lose value. Your emotional response is key. If market drops make you panic and want to sell everything, a conservative approach is better. If you can stay calm and think long-term, you may tolerate more risk. There are 3 main risk categories. High risk means you're okay with big fluctuations and possible losses for higher returns. Moderate risk means you're comfortable with some ups and downs, aiming for balanced growth. Low risk means you prefer stability and are willing to accept lower returns to avoid big losses. As you get closer to retirement, it's wise to reduce risk. This means gradually shifting from stocks to bonds and cash. This helps protect your savings from sudden drops just before or during retirement. Your feelings about market swings matter too. If downturns cause you stress and lead to impulsive decisions, a more conservative portfolio is best. If you can stay patient and think long-term, you might accept more risk. To figure out your risk tolerance, try using questionnaires or online calculators. Review your investments regularly and adjust your asset mix as your situation and goals change. Consulting a financial advisor can also help you craft a plan that fits your personal needs. In the end, the right amount of risk depends on your age, financial health, goals, and how you feel about market ups and downs. Younger investors can usually take more risk for growth, while those nearing retirement should focus on protecting what they have. Keep checking in on your risk level and make changes as needed to stay on track for a comfortable retirement.